Welcome to the video on a quick understanding of the return on marketing investment metric. Just at the outset, what is ROMI for? Basically, it's a very short-term measure, usually measures a particular campaign, and what we're looking for is what is the immediate payback of the campaign. So in the middle there, what we spent or the money of the brand that we put at risk versus what was our gain. So it's just measuring the effectiveness of the return. Obviously in marketing we tend to look long term, so the ROMI's weakness is it doesn't consider long term factors such as new customers and brand building and future purchase intentions as listed at the bottom here. So really it's just a financial return metric ideal for short-term campaigns. So when we're looking at the particular metric, what we're doing is, okay, normally we run the business without a particular campaign or anything special happening, and we make so much money. Then we invest in something such as online advertising, and hopefully what we have is what's called a promotional lift, some extra sales and extra profit. So we've got to work out, gee, for that extra profit compared to what we spent, was that good? Did we do the right thing by the brand and the company? So to work this out, we need three pieces of information. The first one is the campaign cost. The second one is what is the amount of money or profit we make without the campaign. Okay, so that's simply what we would expect to sell or what we would normally sell in that time period, multiplied by our profit margin, which is the difference between our price and our cost of the product. And that will provide us with our expected profit without a campaign. And in technical terms, that's just called our baseline, and it becomes a point of comparison for the extra profit. And then we do the same thing. We run the campaign and go, okay, what profit did we make with the campaign, taking into account the sales, the price and cost, and I've got which may change. So if we do a campaign that includes a discount, usually we end up with a lower margin. And our goal is hopefully to have a higher profit. Okay, let's work through two examples for the same firm or brand. Normally they sell 10,000 units. A price is 20, their cost is 5. That gives them a $15 margin. So normally in this period they would make $150,000. They go, say, to a particular month and they put $20,000 into online advertising. And as a result, they sell more, which is fantastic. So it's a 20% increase. So they've gone up 2,000 unit sales. This is just units, okay, so not profit at this stage. So they've generated a 20% increase or promotional lift in their sales. So we've got to work out, did they make more money and how effective was this? So what we do is we do a side-by-side comparison. What would happen if we didn't run the campaign? This is just our normal, everyday, expected sales, what we're calling the baseline. So what we would normally make is 15,000. In the campaign, we made extra sales at the same margin. So our revenue coming in, what appears to be our top level profit, is 180,000, which is obviously a lot more, but we spent 20,000 generating that, so we have to take the $20,000 off. And the profit contribution of the product for that period of time is 160,000, which is an extra $10,000. So we normally make 150. We did the campaign, and after paying for the campaign, we've improved the brand's position in terms of profit by $10,000. So in terms of our return on marketing investment, it's this extra profit. So what was the end result of all that work? How much better off are we? versus how much money did we invest. So we invested 20 and we added 10. Okay, so that gave us an extra 30 back. Okay, so that's the difference there. But 20 of that goes back into costs. So we actually $10,000 more in the profit or in the bank because of this campaign. So that's a pretty good return, 50%. Now let's look at the example for discounting. So it's the same brand, same normal sales, 10,000, and they're making 150. But instead of doing some sort of advertising, they've cut their price by $5. So their price now is $15. Their cost is $5. That hasn't changed. So their margin has gone from $15 down to $10. Fortunately, during the period, they actually sold 16,000 due to the discount. So we have a 60% increase in sales from 10,000 to 16,000. So we've now got to work out, gee, was that a good idea? Okay, what I've added now is a third column, so I'll get to that in a second. So the same thing as before, 10,000 times 15, we would be on track to sell 100 or make $150,000 in profit. What we did was sold 16,000, but our margin, the profit we make per sale, has been reduced. Okay. So we're now making $160,000. So it appears down here we're making $10,000 extra, which is fantastic. Okay, so what we need to look at, if I just move that there, is what did we risk? So notice I've got the word risk in italics. Now we haven't spent this, but we risked it. Okay, so this is what's actually happened. We sold that many, $10 margin, $160,000 profit has come in for the product, which is an extra $10,000. But what would happen if the price discount did not generate an extra sale? This is what I've got here. Assuming we would normally sell 10,000, we would normally make that money. Okay, so that's virtually guaranteed or pretty well expected by the firm. We go out and say, okay, what we're going to do is only charge $10. Only have a $10 margin. So we are losing $5 here. We would have got that, but we are giving away or gifting or rewarding our customers, however we want to put it, with a $5 discount. So if this discount strategy didn't work, we would only have made $100,000 for the same period instead of $150,000. So we have put at risk, and that's the key word there, risk, $50,000 of the organization's money. So we use that as the base of the marketing investment. Technically we haven't spent it, but that is the downside of the campaign. So if nothing happens, we will be $50,000 worse off. The only way this discount works for us as profit is that we can increase sales volumes. Okay, so we don't actually take it out because it's already come out of money as it's coming in, but then we say, okay, well that is our marketing risk or our marketing investment. So in this case, our return on investment is only 20%. So it's $10,000 over the 50 we risked, and that gives us our 20%. So both campaigns for the same company, both have quite positive return on marketing investments, so both are good, and both generated an extra $10,000 profit for the organization. So obviously that's good as well. But the difference is we risk more in the discount one. So in the ads campaign we spent 20. That goes out the door, probably up front generally, and we got an extra 10, so we made a 50% return. The discount one, although we didn't necessarily pay it out. We ended up with reduced revenue streams coming in because the margin per sale had been reduced. So we effectively put $50,000 on the line. If it didn't work, we were out of pocket $50,000. So we've still made $10,000, but there was a bigger downside. If this didn't work, the ads one, we were out of pocket $20,000. If the discounts didn't work, we were out of pocket $50,000 in terms of reduced profit. So therefore, while they're both good and they both generate profit, clearly the advertising campaign, 50% versus 20%, is more effective in generating profitability. So we probably would continue both, but we would probably do the ad campaigns more often. So hopefully that is helpful. That's just a very simple introduction to the return on marketing investment metric.